Welcome back to This Week in the California Housing Industry, where we take a look at 3 articles that are impacting our California housing industry pros to let them know what's going on in the market and how it is going to impact them. So let's go ahead and dive in. The first article we're going to look at today is that thousands are leaving Los Angeles year after year, yet this is why we still have a housing crunch. Article number 2, very interesting. So 3 ways Kevin Warsh aims to reshape the Federal Reserve, and each one can decimate Wall Street. And then the third article is technically accurate. So California home prices drop and affordability reaches 4-year high in 2026, which is not inaccurate. It's just very misleading. Let's go ahead and dive in. The first article was sourced from the Los Angeles Times, and the thesis is that despite a population decline in LA in recent years, the housing market remains tight. The crunch is largely driven by the lock-in effect and a demographic shift where average household sizes are shrinking. That is a phenomenon that we have talked about a few times on this channel, and we're going to dive in a little more deeply, specifically to LA today. Now, the data shown in the article, the city of Los Angeles lost nearly 10,000 residents last year, while LA County as a whole lost 62,000. Sort of a drop in the bucket with the 14 million or so that are in Los Angeles County, but fairly significant nonetheless. Now, the people leaving are largely lower income workers without college degrees. Crucially, they are generally being replaced by higher income workers who can afford higher housing costs, which is why market demand and prices aren't dropping alongside the population. Now, if you're trying to think specific to Los Angeles, why lower income people might be leaving, think of federal policies and how areas like Los Angeles have been singled out. I'll just leave it at that. Continuing on, the article shows some logic saying the housing shortage isn't just about total population. True. It is driven by the sheer number of households, the type of housing being built, and whether existing owners actually have a practical financial reason to sell. One of the quotes, this is a really good article, you should check it out. But one of the quotes in the article is from Brett Parsons, who says, people sit on homes because they don't want to pay capital gains taxes or the mansion tax. So 2 separate things are being talked about in this article. People leaving Los Angeles, and yet there's still a housing shortage, and people not wanting to sell, and here's part of the reason why. Now into our analysis. There are fewer total people in LA. That is true, but it is a very small percentage drop. Not really going to make much of an impact on the total housing situation. Changing demographics could be interesting if you're losing a few thousand people in the lower income bracket and replacing them with middle income to high income earners. That may make a difference. The concerns about capital gains taxes is really interesting and something that I want to focus on here. If you are in real estate or if you're a lender or a broker, there are a lot of people who would be willing to sell but are scared of having to pay capital gains taxes. So just imagine the demographics throughout LA. Folks who bought 10, 20, 30, sometimes 40 years ago, if they were to sell today, they would be in for a very large capital gains tax. And that is a bill that a lot of people are just not willing to pay. Even if the bill wouldn't be that high or if they could afford it, there's still a fear around it. So if you are a real estate agent, this is critical to have somebody to be able to refer to your clients and say, if you have concerns about capital gains taxes, let me have you talk to so-and-so. And the question for agents out there, are you partnering with tax professionals and the CPAs to help your sellers navigate these penalties and finally list their properties? If not, it's time to find one. And we may have a few in our community as well. So please reach out to us. I'll help you navigate this as real estate agents. For my fellow contractors and investors out there, this is the ultimate validation for ADUs, duplexes, and condos. Condos are still really difficult to permit, just with a lot of red tape. But if the demographics are changing and you're seeing smaller household sizes coming into LA, building small rather than building these large mansions or micro mansions is probably the wave of the future. So keep that in mind. For the developers out there, the data screams that building massive traditional single-family homes is fighting the demographic tide. People are buying smaller. The real money will be in maximizing density and smaller footprint living. Very interesting. Keep in touch with us. We'll keep you posted. The second article is from the Motley Fool. I'll always take all their articles with a grain of salt, but they do produce some interesting tidbits. So let's dive into the thesis here. The 3 things that they highlight from statements that Kevin Warsh has made in the past is that Kevin Warsh wants to reduce the Federal Reserve's balance sheet. He wants to remove the concrete goal of maintaining 2% inflation, and he wants to provide less frequent guidance or do fewer press conferences. The data in here. So among the several changes proposed by Warsh before being sworn in, perhaps none looms larger than his desire to get out of the fiscal business. So essentially flooding the economy by pumping in a ton of additional money with quantitative easing. Before Kevin Warsh got in, we had been on maybe a 2 or 3 year trajectory of quantitative tightening. That has reversed recently. If you look at the federal balance sheet, it started to tick up a bit. But Kevin Warsh has always been a proponent of having a smaller balance sheet. Why does that matter? Well, specifically, the new head of the Fed has been critical of his predecessors, allowing the central bank to be an active market participant well beyond a crisis event, such as a financial crisis or COVID. Between 2008 and March 2022, the Federal Reserve's balance sheet, composed primarily of long-term treasury bonds and mortgage-backed securities, grew approximately tenfold to $9 trillion. Following the period of quantitative tightening, this balance sheet currently stands at a shade over $6.7 trillion. It's a very large number. I think we're just going to go through each of the statements that he's made and then get into some more analysis. But the data, so while speaking before the Senate Banking Committee in April 2026, Warsh offered what he called the old-fashioned definition of inflation that he'd prefer the central bank to use moving forward. His quote about how to define the inflation goal is that I believe that price stability should be a change in prices such that no one's talking about it. That is not a 2% concrete goal. It's just, I don't want people talking about it. We'll come back to that in a second. The last bit of data is that the third and final way Warsh aims to mold the Federal Reserve under his watch is by ditching forward-looking FOMC guidance such as the dot plot. The dot plot is published quarterly and shows where policymakers expect interest rates will be in the coming years. The dot plot has traditionally helped investors estimate how many rate cuts or hikes to expect in a given year. Now let's get into some analysis. So the quantitative tightening is likely to increase interest rates. Full stop. If there's less money supply out there, interest rates are likely to go up. Higher inflation is likely to increase interest rates. Uncertainty about monetary fiscal policy is likely to increase interest rates. So all three of these things that the Motley Fool is highlighting as potential changes coming forward will all have an upward impact on interest rates. So for my brokers and lenders out there, if rates rise and credit tightens, expect fewer applications and more difficult approvals. So winter is coming. As I say, it might be time to tighten the belt. For homeowners, if you are waiting for rates to come down before selling, it may not happen anytime soon. I guess also to say, if you're looking as a potential home buyer, and you're waiting for rates to go down so your mortgage or potential mortgage would become more affordable, that might not be happening either. Now, the last article is from Norada. I don't know how to pronounce their company name, but the thesis of the article in here is that in the first quarter of 2026, housing affordability in the Golden State hit its highest point in 4 years. This means more Californians can actually afford to buy a home than in recent memory, which sounds great. Let's dive into what they are specifically pointing to. So the California Association of Realtors reports that 22% of California households could afford to buy a median price home in early 2026. That might not sound like a huge number, but it's a noticeable jump from 21% in the last quarter of 2025 and a solid increase from 19% in the first quarter of 2025. Apparently a 1% increase is a solid jump. Oh well. Continuing the data, for median price single-family home, which costs around $843,000 in the first quarter of 2026, you'd need a minimum annual income of $204,000 to $205,000 as a household. Interesting numbers there. This income would cover the estimated monthly payment of a little bit over $5,000, which includes your principal, interest, taxes, insurance on a 30-year mortgage fixed at 6.24%. The reason I want to go over this is just getting into some specifics about what a median price costs in California and the fact that household income needs to be over $200,000 to be able to afford that with a $5,000 monthly payment, which I think might be a little low. Continuing the data, if a single family home still feels out of reach, there's good news on the condo and townhome front. In the first quarter of 2026, 32% of households could afford a median price condo or townhome. These typically run around $650,000. Requiring a monthly payment of around, let's say, just under $4,000 and a minimum annual income of $157,200. Let's get into the analysis. So technically, this article is accurate. California home prices have dropped and affordability has reached a 4-year high. But what that means is that 78% of Californians cannot afford to buy a median price home, and 68% of Californians cannot afford to buy a median price condo. The article says that while affordability has improved, it's still a delicate balance. By delicate balance, it means that most people can afford most properties, even if you have a pretty decently high income. I hope these articles are helpful. I'll continue to deliver them weekly to keep our friends in the California housing industry up to speed on what's going on in the market and how it impacts them. If you have any questions, please leave them in the comments. If you're interested in joining the community, please reach out either in the comments or or just look at one of the links in the description below. And that's it for this video. My name is Nathan with the California Housing Collective. Thanks for watching, and we'll see you in the next one.